too far behind. All right, for more on this, let's bring in Dryden Pence, Pence Capital Management Chief Investment Officer. We also have Alfred Eskandar. He's a financial president and chief operating officer. Dryden, let me start with you. We certainly are looking at a day of solid gains. All three of the major averages up well over 2% today. What's your takeaway, not only from the buying we saw today, but really what we've seen play out over the entire trading week?
Well, I think everyone's looking for that idea about pause. And whenever you have anything from the Fed speak that possibly there's a pause in raising the interest rate cycle, I think you're going to see a kind of a hyperactive response, because everybody's been the frazzled cat for the last, couple of months. So things have been, a little too negative whenever any bad news comes out. And then sometimes we get a little overreactive on the positive side. So anytime you get something about the Fed's possibly going to pause, then you're going to see this massive reaction. Sometimes it can be an overreaction as well.
And that's the question, isn't it, Alfred? Because San Francisco Fed President Mary Daly, you have to really seek out the dovish comment. And she said the time is now to start talking about stepping down. The time is now to start planning for stepping down. But she was clear, this ain't it. Are we overreacting? Are the markets, rather?
I don't think it's so much of an overreaction as a release. We've had volatility spiking all year. I mean, if you think about where volatility began in January, where we are, it's up 73%. So think about the rocky road that investors had to deal with. You couple that with obviously the moves from the Fed, inflation, and everyone feeling the pinch at home, and then you get a psychology really coming into play with the average investor. So when you have huge down weeks like we've had in the last couple, a week like today is fantastic. It feels great to be up, almost 5% on all the major indices for the week. But that is not a respite for, it's the all clear sign. What we have to understand is the rest of the year is going to look pretty much like this. We're going to have massive weeks up and massive weeks down. And, it is not for the investor with a soft stomach.
Dryden, what do you think needs to happen in order for there to be some more conviction in the market and for you to be more bullish?
Well, I think there's three big terms out there. We're looking for peace in the Ukraine, we're looking for a pause, or we're looking for verification of the peak in interest rates. And so far, our core has not peaked yet, and we're not going to really get until middle of next month, either after this next Fed move, the next read on inflation, and that's going to probably not be a pretty read. Core hasn't peaked yet, we think. And so I think you have to get past where we have this moment of assurance that we probably have hit peak, both core and headline, and that we are actually legitimately talking about a pause in the rise in the federal fund rates. I don't think a pivot is probably something to be afraid of, because I think if they pivot, they've broken it. But if they move to a pause, an extended pause period of time, because consumers have to catch up. We can trade policy. You can change policy overnight or within a day, or markets will check in a day. But consumers, the drivers of inflation, have to catch up. It takes 6 or 8 months, and I think that we're forgetting that. So for me to be bullish again, we have to begin to see that policymakers are beginning to give the consumers some time for reality to catch up with what they're trying to do.
A lot of P's in there. So Alfred, when do we see that pause, and when do we get an indication that inflation is beginning to at least peak?
Well, the numbers are going to guide us, and certainly the Fed will respond accordingly. But in lieu of all that, I think investors really need to take a look at their portfolios and understand the risk exposure. And depending on who you are, if you're a young investor, guess what? You've got time. You could actually ride out, this volatility, for the next few quarters. However, if you're a little bit older, thankfully, there are plenty of products that have been introduced in the last 10, 15 years that are quite sophisticated, that are really terrific defensive products to use when markets are this volatile. If you're 55 and you're thinking about retirement, seeing a 20% drawdown in the S&P, 30 in NASDAQ, that's not what you want to experience. So there's plenty of products out there. Think about the risk in your portfolio and be defensive. Winning is also akin to not losing. So the less you lose, the more you win in markets like this. And I think taking a much more defensive posture for those who have been in the market for quite a bit is the right thing to do. It's the prudent thing to do right now.
Can you give some of those older investors some of those products?
Sure. Well, listen, anything from fixed index annuities, structured products, and then on the super accessible, easy thing are buffer ETFs. Now, granted, they're not going to protect you for the total downside that we've seen this year in the markets, but being down 10% versus being down 25 is still a win. So again, defensive sectors, defensive products that actually can give the investor downside protection to some extent or completely are some things that should be added to a portfolio. It's not just about stocks, and certainly bonds have been down this year as well. So we got to think about the portfolio a lot differently. The 60-40 is kind of outdated. Yeah.
Dryden, what do you think? And I guess where are you seeing the most opportunity today in terms of what investors should be doing?
Well, one thing we have now that we have not had in years is we have an interest rate. And so for some investors, actually it's appropriate right now. The 2-year is actually yielding pretty good. And so if they think about long term, we're going to have rates go down. Now's a good time to think about sometime between now and the end of the year, maybe adding some 2-year treasury to the portfolios, because now you can, if you're trying to get 8 long term and compound that, well, a 4 1/4 gets you halfway there. Mm-hmm. And so, but the other side of it is when we think about looking at who's going to do well in a continued inflationary environment, and we actually see that barbelling things make some sense to the consumer. You have companies like Walmart and some of the ones who are helping the low-end consumer. You have people who are making over $80,000 a year now moving down to that market. So you're going to see continued growth there. And so and actually, wages have grown faster than inflation. So you see wages growing faster than inflation for people at the lower end of the economic spectrum. At the higher end of the economic spectrum, their incomes are rising as fast as inflation. And so it's kind of this barbell between LVMH, luxury goods, and Walmart. But it's the people in the middle that are going to continue to have problems as we get into 2023. Maybe we have a small recession. They're going to be hurt the most. And so you kind of break it up. When you think of equities, think of barbelling those two ends of the consumer. And I think in the center, you're going to have some challenges for the Macy's, the Targets, and those guys, because their customers are going to move to either side.
LVMH, Walmart, barbell is a fascinating one. Dryden, thank you. Appreciate you coming out in the studio. Alfred, you come see us next time. Both of you guys have a good weekend. Appreciate it. Coming up, Stuck Bar.